You have spent your entire working life contributing faithfully to your superannuation. Pay packet after pay packet, year after year, decade after decade. You have watched that balance grow from a few $1,000s in your 30s to a meaningful sum by the time you reached your 60s. You have read the annual statements, ticked the boxes on the forms, and trusted that the system would quietly do its job in the background. And then suddenly, out of nowhere, you start hearing whispers. New super tax laws have passed Parliament. Contribution caps are changing. Transfer balance caps are shifting. Something called Division 296. Something else called Payday Super. A friend tells you that retirees with balances above a certain threshold need to act before September 2026 or face thousands of dollars in extra tax. Your heart sinks. Because if that is true, everything you planned just changed overnight. The super balance you carefully built, the drawdown strategy you assumed would carry you through retirement, the inheritance you hoped to leave the grandchildren, the comfortable margin you thought you had above the age pension thresholds. All of it suddenly hangs on rules you have not had a chance to read, let alone understand. Stop. Take a breath. Before you panic, before you ring your accountant in distress, I need you to listen carefully. Because the changes coming through the Australian superannuation system in 2026 are real. They are significant. And yes, there are genuine deadlines, but most of them are not the catastrophe the social media posts are making them out to be. Over the next 22 minutes, I'm going to walk you through exactly what every Australian retiree with superannuation needs to do before September 2026. What has actually changed in the law? What is just noise on Facebook? The genuine deadline that affects the highest balances, the smaller deadlines that affect everyone else, and the one quiet action almost every retiree should take this year. This is not clickbait. This is not speculation. This is the truth, straight from official sources explained in plain English. Welcome to Centrelink Daily AU. Let's get into it. You have probably seen it everywhere. The Facebook groups for Australian retirees have been buzzing all year. WhatsApp messages forwarded from worried friends. News headlines warning of tax grabs on superannuation. YouTube thumbnails with red arrows and screaming text. A nephew who works in finance telling you over Sunday lunch that you need to restructure everything immediately. A neighbour who has just sold his self-managed super fund's investment property because someone told him he had to. You have probably read at least one alarming article. You have probably felt that cold knot in your stomach, wondering if your modest balance is suddenly going to be hit by something new. Maybe you have already started moving money around without fully understanding why. Maybe you have postponed a planned super contribution because you do not know whether the caps are going up or down. Here is what I want you to understand. The panic is louder than the reality. The most dramatic new tax in the Australian superannuation system, known formally as Division 296, applies only to individuals with total super balances above $3 million. The 2026 to 27 income year is the first year it applies. That covers roughly the top 0.3% of Australians by super balance. The other 99.7% of Australian retirees are not directly affected by that particular tax at all. But that does not mean there is nothing for the rest of you to do. There are quieter, broader changes that touch almost every retiree, and the window between now and September 20th, 2026, when the next age pension indexation cycle kicks in, is the perfect time to review your super, your contributions, your drawdown rates, and your age pension position together. So let's deal with this head on. Here is the confirmed fact. The Australian Taxation Office has confirmed that from July 1st, 2026, several significant changes take effect across the superannuation system, alongside the Division 296 tax that begins assessment for balances measured during the 2026 to 27 income year. The Department of Social Services has separately confirmed that the age pension thresholds will be re-indexed on September 20th, 2026, as part of the standard biannual indexation cycle. The two systems run in parallel, and they interact in ways that catch many retirees off guard. I want you to hear that again. The 1st of July 2026 changes are the superannuation rule changes. The September 20th, 2026 indexation is the age pension threshold update. Both happen in the same financial year. Both affect retirees. The Australian Taxation Office has confirmed that the super guarantee rate, the percentage your employer must contribute to your super, is now locked in at 12%. The contribution caps for concessional and non-concessional contributions are being reviewed, with the transfer balance cap, which is the lifetime limit on how much super you can move into a tax-free retirement income stream, expected to increase due to indexation. Straight from official sources, Division 296 introduces an additional 15% tax on earnings attributable to the portion of a person's total super balance above $3 million. That is on top of the standard 15% tax that already applies inside super. Balances above $10 million are taxed at higher rates. The first assessments under Division 296 cover the 2026 to 27 income year. Now let's talk about what actually changed in 2026, because while the headlines focus on the rare Division 296 tax, several quieter adjustments will touch almost every Australian retiree. From July 1st, 2026, the Payday Super reforms begin rolling out for those still in the workforce. Under these reforms, employers must pay your super contributions at the same time as your wages, rather than quarterly. For working retirees using the work bonus, this means contributions arrive in your super account faster and start earning returns sooner. From July 1st, 2026, the concessional contributions cap and the non-concessional contributions cap are indexed in line with average weekly earnings, which means many retirees gain a small uplift in how much they can contribute before tax penalties kick in. The transfer balance cap also typically indexes during these cycles, allowing larger amounts to move into the tax-free pension phase. From September 20th, 2026, the age pension thresholds will be adjusted again. The maximum single rate, currently $1,200.90 per fortnight after the March 20th, 2026 indexation, will likely lift modestly. The full pension asset test thresholds will also shift. This indexation cycle is the natural deadline for retirees who want to align a super withdrawal, a contribution, or a portfolio rebalance with the new threshold figures. The hidden change for 2026 is the dramatically increased data sharing between superannuation funds, the Australian Taxation Office, and Services Australia. When you receive a pension payment from your super, when you make a contribution, when your balance crosses a threshold, the system increasingly sees these events in close to real time. The need to plan ahead rather than react after the fact has never been more important. If you are 60 years old right now, you have 7 years before you reach age pension qualifying age of 67. Your super is still outside the age pension assets test, which means you have a genuine window to make strategic contributions and structure your balance before pension age. If you are 62 or 65, you are in the most powerful planning window of your retirement life. Your super is still exempt from the age pension assets test, but it is also accessible because you have reached super preservation age. Strategic contributions in these years, especially using the bring forward rule for non-concessional contributions, can permanently shape your future age pension entitlement. The window closes the moment you reach 67. If you are 67 and have just qualified for the age pension, your superannuation is now fully accessible under both the assets test and the income test. The September 2026 indexation cycle is a perfect moment to review your balance and check that your reported figures with Services Australia are accurate. If you are 70, 75 or beyond, the structural reforms of 2026 still affect you. Your account-based pension drawdown rates, the deeming rates applied to your super, and the way the assets test treats your balance can all shift during indexation cycles. Now, here is the genuinely good news buried in the 2026 reforms that almost nobody on Facebook is telling you about. First, the increase in the transfer balance cap means many Australians will be able to hold more of their super in the tax-free pension phase than ever before. That is a structural win for retirees, especially those with balances well below the $3 million Division 296 threshold. Second, the rise in concessional contribution caps from July 1st, 2026 gives older Australians still in the workforce more room to make tax-effective contributions. Combined with the work bonus, which allows you to earn up to $300 per fortnight from employment before it touches your pension, with a balance that can build up to $11,800, the 2026 settings are surprisingly retiree-friendly. Third, Payday Super means working retirees see their employer contributions arrive faster, compounding sooner, and showing up in their super balance on a more frequent basis. Fourth, the Services Australia Financial Information Service remains completely free for older Australians. A single 30-minute appointment before September 20th, 2026 could save you thousands of dollars across your retirement. Fifth, and perhaps most importantly, the vast majority of Australian retirees are not directly affected by the Division 296 tax. The threshold of $3 million in total super balance places that tax firmly in the realm of high net worth retirees. Let's talk numbers. The maximum age pension rate from March 20th, 2026 is $1,200.90 per fortnight for a single pensioner, which equates to approximately $31,223 per year. For couples, the maximum rate is $905.20 each per fortnight, or $1,810.40 combined per fortnight, which is roughly $47,071 per year combined. These figures will be reviewed again on September 20th, 2026. The age pension assets test thresholds from March 20th, 2026 are critical. For a single homeowner, the full pension is payable for assessable assets under approximately $321,500. The part pension cuts out completely at around $722,000. For a homeowner couple, the full pension threshold is approximately $481,500, with the part pension cutting out at around $1,085,000. Your super counts towards these thresholds once you reach 67. The income test free area is $218 per fortnight for singles and $380 per fortnight combined for couples. Above that, pension reduces by 50 cents for each extra dollar of assessable income, including deemed income on your super. Deeming rates from March 20th, 2026 are 1.25% on the first $64,200 of financial assets for singles and 1.25% on the first $106,200 for couples combined, with 3.25% applied to anything above. The Division 296 tax applies an additional 15% rate on earnings attributable to the portion of your total super balance above $3 million. So a retiree with a balance of $3,200,000 is only subject to the extra tax on earnings attributable to the $200,000 excess, not on the whole balance. That distinction matters enormously. The concessional contributions cap, which limits before tax super contributions, is currently $30,000 per year. The non-concessional contributions cap for after-tax contributions is $120,000 per year, with the bring forward rule allowing up to 3 years' worth, or $360,000, in a single year for those who qualify. Now let's talk about eligibility. To receive the age pension, you must be 67 years of age or older. You must be an Australian resident, generally with at least 10 years of Australian residency, including a 5-year continuous period. You must satisfy both the income test and the assets test on an ongoing basis. The primary home exemption is one of the most important protections in the Australian retirement system. Your principal residence is generally not counted as an assessable asset for age pension purposes, no matter how valuable. This is critical when planning around your super, because your super is fully assessable from age 67, but your home is not. To make non-concessional super contributions, you generally need to be under 75, with some specific exceptions. The Bring Forward rule has age-based eligibility tests, and recent contributions and balance figures affect whether you can use it. For Division 296, the eligibility test is your total super balance at relevant measurement points during the 2026 to 27 income year, with a $3 million threshold for the first tier of additional tax. Now, here is the trap to avoid. The single biggest mistake Australian retirees make in a year like 2026, with so many changes coming through, is reacting rather than planning. Making sudden withdrawals, abrupt contributions, or panic-driven structural changes to your super based on a headline you read on Facebook is almost always more expensive than calmly reviewing your position with proper professional advice. I have seen retirees move large sums out of super into ordinary bank accounts to avoid Division 296, only to discover their balance was nowhere near the $3 million threshold, and they have now lost tax-free pension phase status on the withdrawn amount. I have seen others rush to make non-concessional contributions before a cap change, without realising they had already used their bring forward allowance in a previous year, triggering excess contribution penalties. The trap is haste, not the rules themselves. The fix is the opposite of haste. Sit down, read your last super statement carefully, check your total super balance, ring your fund, or use your fund's online member portal and confirm exactly where you sit relative to the thresholds. Then book a free appointment with the Services Australia Financial Information Service. Do this before September 2026, not after. Let me clarify a confusion I see all the time at Centrelink Daily AU. The first is the difference between super preservation age and age pension age. Super preservation age for Australians born after July 1st, 1964 is 60. Age pension age is 67. These are completely separate ages. Many retirees confuse them, assuming that because they can access their super at 60, they should also be eligible for the age pension. They are not. The second confusion is between super in accumulation phase and super in retirement phase. In accumulation phase, your super earnings are taxed at 15% inside the fund, and the balance does not count in your age pension assets test until you reach 67. In retirement phase, your super sits in a tax-free environment up to the transfer balance cap, and any balance above that cap stays in accumulation. The distinction matters for tax, for drawdown rules, and for how your fund reports to the Australian Taxation Office. Why is all this happening in 2026? Australia is ageing rapidly. According to the Australian Bureau of Statistics, more than 16% of Australians are now aged 65 or over. The cost of the age pension to the budget is already enormous and growing. In response, governments have moved progressively to tighten the most generous tax concessions in the superannuation system. Division 296 is part of that long-term direction, targeting the highest balances first. The Australian Taxation Office now shares super contribution and balance data with Services Australia more efficiently than at any point in history. The ratio of working-age Australians to retirees has shifted. In the 1970s, there were roughly 7 working-age people for every retiree. By the mid-2030s, that ratio is projected to fall to around 2.5 to 1. This long-term pressure is the structural reason why super rules are being adjusted, not because anyone is coming for ordinary retirees. This is not a hostile policy direction. It is a careful rebalancing of an enormous system. The retiree who plans calmly has nothing to fear. Here is what I want you to do this week. First, log into your Superannuation Fund's online member portal today and check your total super balance, your current pension drawdown rate, and your transfer balance account. If you do not know how to find these, ring your fund and ask them to walk you through it. Second, log into your MyGov account and check that the super balance and Pension Information Services Australia holds for you matches what your fund is reporting. If anything looks out of date, update it through your Centrelink online account before September 20th, 2026. Third, if you are between 60 and 67, consider whether you have any unused contribution capacity. The window to make tax-effective, non-concessional contributions while your super is still exempt from the age pension assets test is one of the most powerful planning tools available. Fourth, book a free appointment with the Services Australia Financial Information Service. They can model your specific situation and help you understand whether any action is genuinely needed. Fifth, if your total super balance is approaching or above $3 million, speak with a licensed financial advisor who specialises in Division 296 planning. If this video helped you cut through the confusion today, please hit the like button right now. It genuinely helps more Australians find this information when they need it most. Subscribe to Centrelink Daily AU and hit the bell so you never miss a daily update on the age pension, Centrelink rule changes, or any government payment that affects Australian seniors. And drop your question in the comments below, whether it is about Division 296, the 1st of July 2026 contribution caps, the 20th of September age pension indexation, or anything else. We read every single comment, and your question could become our next full video. Share this video with another Aussie senior who needs to know this, because the more informed we are, the harder it becomes for any of us to be caught off guard. Until the next video, stay informed, stay prepared, and remember, your retirement deserves to be built on facts, not fear. From all of us at Centrelink Daily AU, take care, and we'll see you tomorrow.